Peter, there are investors, value investors, for example, who no matter what will not pay up, will not pay a premium for any stock, for the Amazons of the world, so to speak. You're different. You're growth at a reasonable price, and you're okay with that. Why?
I would rather pay up for a great company than get any bad company cheaply. And so in my investment career when I was a fund manager, that proved to be the single best thing that I could do, is to pay a lot of money for a great company. Now, you don't just pay willy-nilly whatever you want. You have to understand why it's expensive. And so if your company's expensive because it's got a premium growth rate, or it's got no debt, or its cash flow is massive, or its free cash flow is massive, or it's got a high dividend ownership, or ideally it's got a competitive edge, Amazon might be the great example there, then it's worth a premium. And you have to decide if that premium is sustainable, and you have to decide if that premium is justified, and you have to decide what happens if people change their minds about that premium. But if you can get a great company, then I think you should pay up for it. You shouldn't want to nickel and dime your way, to the poorhouse. And I've seen a lot of people look at great companies, Netflix at $10. They say, okay, I'll wait till it's $8. Mm-hmm. And now it's the equivalent of $900 after the splits. Right. And so it's a situation where if you really like a company, you should like it. And you shouldn't have to say, okay, I'll wait for it to be cheaper. Obviously that helps if you can get it cheaper, but I've seen too many investors miss opportunities that way.
One of your winners has been Savaria, which you recommended to our subscribers about a year ago in the article I talked about. Remind me of the business. What do they do?
So it's really medical products for the elderly. So one of their early entrants in the industry was making lifts for vans. So if you're in a wheelchair, you have to get your wheelchair into the van, and it's sort of driver assist and things like that. So they've gone out and they've made some more expansions and acquisitions, and they bought a company called Span America recently, which makes medical beds and other facilities or other products that in your home when you're sort of, I don't want to say invalid, but when you're at home and you're not spending a lot of time outside, there's all these products that you can sell to that patient. Then they bought Shoppers mobile division. So again, for anything for mobility and vans and transportation. So they've done that in a very, very good job executing in acquisitions. Of course, the industry is growing, the population is getting older, and so their product offerings are starting to increase, and they've really shown a really, really good growth rate. And they've done it all while they've kept their balance sheet really, really clean. So it's a great little story with insider ownership. You've got the demographics. It is not cheap. It's 30 times earnings, and some people say, okay, that's too expensive. But last year, I think a little bit after our interview, they raised their dividend 30%. So they're paying you to go along on board with their growth. And now it's a bigger company, more diversified, much more U.S. revenue, and you're executing very well.
And insider ownership is still around 40% or so?
Yeah, they haven't, I don't think they've sold anything of significance, and some people get worried about insider ownership or insider selling, but we always look at what the price has done. So if you have, say, a 40% position in a company and the stock's doubled, you can sell a little bit and your actual monetary exposure is higher than it was before because of the stock. So, we'll grant some insider selling. We don't want to see them massively selling or anything like that, but around tax time, around year end, around option grants, we'll let some insiders get away with a little selling.
So you mentioned a lot of fundamental factors in Savaria's favor. What's the potential for the stock, do you think?
Well, I think it really depends now on their acquisition strategy. So their last acquisition, Span America, was very, very big for them. It was about $80 or $90 million US. And considering that the whole company size 5 years ago wasn't that big, it was a very, very big step. So I think it's good. It's going to add about 30% to their cash flow and their earnings, and the stock has responded accordingly. So now it's like, okay, now we've got Canada. They've got an operation in China as well that's potentially going to be very, very big. They want to go slow there because they don't want to blow their brains out spending money. But perhaps they'll do another acquisition in the US, and they're slowly sort of capturing market share of a growing market. And that's one of the reasons why we like it, is because even if they stay stagnant, you and I are getting older, and one day we're going to be using their products, and they've got a captured market for future business. So I think the stock has the potential to go above 20. It's gotten pretty close in the past, and one acquisition or a solid growth rate or another dividend increase. And of course in Canada, as the market cap goes up, more investors take interest, and you can get a higher valuation just because more investors now can buy you.
Let's talk about Photon Control. We interviewed the CEO, Scott Edmonds, here on Capital Ideas TV recently. Again, with this company, remind us of the business. They're in the semiconductor equipment manufacturing sector. They supply components, correct?
It's largely etching. So etching is one part of the semiconductor business where basically the wafer, things are stripped away from the wafer, leaving what you need behind. And so they do have an optical business in the oil and gas, and they have a sensor business as well, but it's really semiconductors that are driving it right now. So it's partially a company play and partially an industry play. So as you've seen from NVIDIA and AMD, I mean, the semiconductor market is clearly on fire right now. And in Canada, some of the semiconductor companies in the past, I mean, if you're as old as me, you know, you had Genum Semiconductor, ATI, Tundra Semiconductors, they were all acquired.
Right.
There's really very little way to play the sector in Canada right now. So Photon is 95% of their business comes from the sector. They have $32 million in cash. It trades at 16 times earnings. Their growth rate is in the 80% range, and they're riding that wave of sector, the sector boom that's happening right now. So the stock's done quite well. I think it's up 45% or so as we speak. But there's lots of potential, and they just added a new customer that they've had to ramp up. And so they're kind of in the right place at the right time. So, okay, well, what are the risks? Their balance sheet's perfect. We could see insiders owning a bit more. We'd like to see a bit of insider buying there. Or their growth rate could slow down. And, you know, there are always risks, but in terms of the sector right now, it's hard to see the growth rate slowing down, especially with a new customer that they just signed on board.
And in a year's time, where do you see the stock, do you figure?
Well, much will depend on the sector. The sector is very volatile, but it's hard to envision the sector turning over in a year. There's so many drivers of semiconductors right now. It's artificial intelligence, augmented reality, automated driving, cryptocurrencies. I mean, it's really hard to see the sector rolling over within a year. So you've got a 16 times multiple stock with a bunch of cash. So maybe they do an acquisition, or maybe they just keep growing at 50% plus. And I could see in the sector a small cap, high growth company with no debt. I could see 25 times multiple on it. So you've got a 50% gain in the stock, even in a change in multiple. So much is going to depend on the growth rate. I don't think they can grow at the same rate as the last quarter. It was just a blowout quarter in terms of growth. But I think the growth rate will remain 40%, 50% for a couple of years. And that should get noticed. And if it can get to 200 million market cap, more investors might come on board. And they'll probably like what they see at that point. Because again, nothing's probably going to change. They'll still have a lot of cash. They'll still have an okay valuation. And they'll still be in one of the hottest sectors around.